So again, welcome to identifying transitional markets and how to set up trades within this environment. This is probably about as timely a talk as we can have right now, because I don't know how many of you are actually looking at the kind of chop and slop that we are seeing in the Dow right now, the dollar right now, in the Euro-US dollar right now. In many pairs, we're starting to see a lot of markets that had been in trends. For example, let's take a look, let's zoom into this Aussie yen here. See a lot of markets that had been in trends, but they transitioned out of the trend. Now, on one hand, when we do have a trend, and we define that by the continuation of the green grab candles, then the angle, the 12 to 2 o'clock angle of the 34 EMA wave, that's how we identify and confirm that environment. What we had then was what we call a transition. So the uptrend was no longer the dominant psychology. We broke the support of the 34 EMA wave. The market then went into more of a sideways market. Now, just because we've broken the uptrend doesn't mean we then now have a downtrend. I think that's an initial mistake that a lot of traders tend to kind of leap to prematurely. One of the phases, this is very much inspired by my interpretation reading of Charles Dow, one of the phases is going to be, what do we see when an uptrend is broken, yet we haven't enough organization to pull the market down into a downtrend? The early stages of a downtrend, which is probably what we're looking at here on the Aussie yen, is a pretty good look at just how vulnerable these markets are. All right, so looking at the vulnerability of a market that is in a fresh downtrend. And when I say fresh, what do I mean by that? We have to step back and talk about the clarity criteria here for a moment. What are the criteria for clarity, for market clarity? Let's make this a little bit bolder here. There we go. It'd be nice if I spelled clarity right, wouldn't it? So what we're looking at for market clarity, the criteria, starts with, even preceding any of this is, do we have a clock angle, a recognizable clock angle, one that we can feel is one that will then begin to ask the clarity criteria of. So if we have it, then we'll go through the clarity criteria, which then is, do we have a smoothness to the moving averages of the wave? Okay. Are they established? And this is really at the heart of what I call a fresh downtrend. Because if they're not established, that means we might have a clock angle, but they may not have been moving in that direction for very long. The last part of the criteria, you can see here, is going to be, are they respected? And again, in the situation of a fresh market, we don't always have the ability to see if the wave is being respected as support or resistance. Here would be resistance. So notice we have the overall downtrend identified by the succession of red grab candles. We have the angle of the 34 EMA wave moving lower at that 4 to 6 o'clock angle. And we actually do have a couple tests of the wave at the 34 EMA low. And it does seem to be respected. So this is an unusual situation where we have smoothness and respected, but we really don't have an established downtrend yet. In other words, it's arguable and it's still susceptible to perhaps finding a larger range and trading within it, whether that be support level down here and a resistance level up in this area. Regardless, we're looking at a market that could really be in a situation where it could define a non-trending, choppy market. But for now, the bearish sentiment momentum and arguably the trend are in place. Now, transitional markets, and this is one, anytime I talk about a trend being a fresh trend, that means it is susceptible to the volatility that will often accompany a market that does not have an established trend. Let's take a look. Let's compare this to a more established trend, shall we? Let's take a look at the Aussie US dollar. So here we have a market that is in a slightly more established trend. This market has a different problem. This market is not necessarily transitional, but it's got this big obstacle called the 200 period simple moving average on the daily time frame problem. So what we have here is a market that is in a more established downtrend. We can see the succession of the red grab candles. We can see the moving averages have been moving downward at 4 to 6 a little bit longer, although it's not a steep angle. It is established, but one of the things that is keeping this market from pushing to lower lows is this 200 period simple. Notice the support it's offering right now. This is not necessarily a transitional market, but it's one that has a different kind of obstacle. And it's very similar to what we deal with when we have a transitional market, because what happens when a market is in transition? The question mark hangs over what is the market's capacity for follow-through. That's the challenge there. What is the market's capacity for follow-through? So having said that, and having dealt with the kind of issues we have regarding a lot of time frames, just again with this issue of can we see a downtrend follow through? The euro yen is in a very similar situation. Again, by the way, notice that I want to use current market examples. I don't want to be in a situation where I'm using examples from way back when. These are current looks at the market. These are challenges that I'm even being faced with right now as I look at my personal trading. Okay, so these are questions that I'm asking myself right now. And again, if you have any questions about what I'm talking about, or if you have a particular pair that you would like me to take a look at, please don't hesitate. Go ahead and type it in on the question window, and I'll see that pop up on my end. Okay. What's the problem here with the euro yen daily? Very similar to the Aussie, right? Is this a fresh downtrend? Yes. This has two of it. This has kind of a familiarity back to that Aussie yen issue, as well as the Aussie US dollar, where we have a very fresh downtrend with respect, and we have the 200 period simple acting as support below. What happens in these environments? Imagine, if you will, what happens when you've been moving one way for a long time. You know, you've been going in a certain direction. You know what? Here's a good example. It just came to my mind. 2013, next year. How long will some of you continue to write 2012 on your checks? Do people actually write checks anymore? All those electronic transactions, but on your letters, on your emails, on your checks, how long will you continue to write 2012 when it's 2013? Some people switch right away. They can make that switch. Some people will be writing 2012 by accident even come March. And some people are somewhere in the middle, right? We were one way for a long time, 2012, and then here comes 2013. A shift in a trend works the same way. Some people will switch and recognize even the subtlest changes and make the move. Some people will take longer. Some people will take a very long time before they make the shift, okay? So having said that if you've done something a certain way for long enough and suddenly something changes, how much of your muscle memory, how much of your expectation, how much of your thinking is still in the old way? Well, that's what happens here. And the more established a trend it is, the tougher it is to shift, because you were set in that way for a much longer time. When it comes to trends, that's what happens. So there might be some people who are still going to be clinging to bullishness as long as price action is north of that 200 DMA, 200 daily moving average, which is also the 200 period simple moving average on the close. So how many people will be continuing to cling on to at least some kind of bearish sentiment above the 200? There's an argument that quite a few people will be. So as long as we are trading below this resistance level, but above this support that I'll define by the 200 DMA, there's a good argument for some confusion. And that's what we're likely to deal with. So that's what I'm talking about, markets that are in transition. There's not a clear bullishness or bearishness about them. And recognizing them is not just using the 34 EMA wave and the grab candles, although that does handle about probably 80% of the questions you'll have regarding what market trend or phase are we in and how established is it. But there are other levels, like recent highs and lows, like 200 period simple moving averages. And like I said, there are a number of charts that are dealing with this level. So going then on to the dollar yen, let's take a look at another chart. Here we have a chart that is not necessarily dealing with, let's clean this chart up here. Here's a chart that isn't necessarily dealing with the transition of dealing with the 200, but it's just dealing with the transition period. Okay? We're dealing here with a transition regarding the wave itself. We went from a very strong uptrend on the dollar yen to a little bit of hesitation. Here, see the blue mixed up within the green as the angle of the wave began to lose that steepness. The trick is when we actually confirm the rollover, when we break the support of the 34 EMA wave. In this case, when we break down lower through the 34 period EMA on the low. So we break down through that 34 EMA on the low, prices begin to trend lower, as you can see here. And it's the support within the couple areas. Support is actually an 89 period exponential moving average, which is part of my Lazy Days line series. I will look at that. We don't have to deal with the 200 period symbol till way down here. This is a market that's transitioned. It was moving up, 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 up. Okay. Then it went neutral for a little while. Started going sideways, moving neutral. Broke the support of the 34 EMA wave. And now we're seeing the negativity coming in. Okay? So the question is, will this wave be able to contain the price action? There's a few things that I can look to determine that. And there's a few reactions I'm going to have as the market is in this environment. So number one is identifying the environment. That's absolutely number one. Let's go into our indicator list and I'll show you what we have here. And I like to have certain colors so I know what I'm dealing with. There's a 20 period simple. I actually have an 89 here, which is kind of unusual. I don't always have that on my chart. And there's that 200 period. The one thing I'm missing on this particular chart, I'm actually on a different computer here today for our talk, but the other thing that I'm missing, and I like to have, is the 50 period simple on the close. That's another one that I like to have. So there is my 20, 50, and 200 period simple along with my 34 EMA wave. Pretty interesting that today, and basically what we're seeing, I guess the actual cross happened probably 2 or 3 days ago, but actually today what we're seeing is the 20 period simple following down lower through the 50. That's not necessarily a signal for me, but I won't underestimate the power of what that means to maybe a group of people who do look at these types of crosses. Psychologically relevant moving averages like the 20, 50, 200, when they start crisscrossing with one another, there are plenty of scans and there are plenty of people who watch these and will then look for opportunities to capitalize on that type of shift. In this case, we're talking about a shift of the 20 slicing down through the 50. Again, not something that I will trigger a trade on, but I should recognize that psychologically speaking, it probably means something to quite a group of people. For me, I'm actually looking for opportunities to short this market between the 34 EMA low and the 34 EMA on the close. And as you notice right now, we're kind of in that area. Is this an established downtrend? No. So this is typically a setup that I would use in an established downtrend. Swing trading, I would use typically my 20 period simple and my 34 EMA on the low, but since that 20 period simple is way up here, I can look for another zone between, for example, the low and the close of the wave. Regardless, though, this is a transitional market. Here's the question you have to ask yourself. Is there, and there's two criteria, is there a clear and dominant psychology at work here? Is there a clear and dominant psychology? I don't think there is. I don't think there's a clear and dominant psychology. I know there's bearish sentiment and momentum, but I can't say that overall we're in a downtrend. There's no dominant psychology here. We have a little bit more bearishness, no doubt. We're no longer bullish, but we're probably bearish to neutral. So again, the point is, it's in a vulnerable stage of what we would consider to be perhaps a fresh downtrend. And with that vulnerability comes volatility. You know, anytime I start talking about a vulnerable trend, I'm not talking about one that's willing to cry quickly. I'm talking one that's vulnerable to volatility. That's the bottom line. And if anybody has any questions, go ahead and type them in. I'll be more than happy to address them. So if I know that a fresh downtrend is vulnerable, and a vulnerable trend is subjected to the kind of volatility that comes with people shifting their opinion at different stages of a change, again, kind of using that shift from 2012 to 2013 and how quickly we can stop writing 2012 on everything and how long it takes us to adapt to 2013, shifts in the trend are the same way. There's no way of saying that everybody's going to do it at the same time, because they won't. It'll happen in stages. But the further into 2013 we get, in other words, the more established the year is, the less likely we are to write 2012. Well, the more established the downtrend is, the more likely people are to agree that it is a bearish environment. So what do we do when we recognize the different stages and different types of this vulnerability, this volatility that comes from transition? What we have to do is typically retreat to shorter term time frames. And what I mean by that is look for opportunities that are occurring on the 5, the 15, staying nimble so that as the volatility comes into the market, if one session is an up day, the next session is a down day, whatever it is, we can stay in a time frame that's nimble enough to let us adjust. That's the key, being able to adjust. So one of the things that we always want to remember is if we cannot adjust, we will always be in an environment where there'll be confusion as to whether or not there will be enough participation to create follow-through. And that's really the question here, gang. That's the challenge in this environment. Do we have enough to create the kind of follow-through that we need? Follow-through is something that a lot of traders sometimes neglect when it comes to understanding what it is that we have to consider in terms of our trade. It's easy to kind of glance over follow-through expectations when the trade is finally triggered, one that we might have been waiting for a while. It's easy to forget that the importance of the sentiment continuing is key to what? Key to us reaching our profit target. That's a big part of it, isn't it? And a lot of times people will really neglect the importance of that in respect to their trade. How many of you out there will consider follow-through as a key part of what you will need the environment to do for you to be able to get what you want, which is, what do we all ultimately want? We don't want to be stopped out. We want the trade to go to what? A profit target. Right? That's no secret. All of us want that. All of us want the trade to follow through. Yet, a lot of us will not consider what has to happen. What is the underlying environment of risk? What's the underlying expectation price movement before we see that kind of movement? That's often the challenge we have. Does that make sense to everybody? And the bottom line is, in a transitional environment, follow-through is very difficult to come by. Follow-through becomes my requiring that a market that is telling me that it's confused, a market that is very obvious about the fact that there might be a number of differing opinions, that because of those differing opinions, we could really lack the clarity in psychology to see a move lower continue or a move higher continue. I know that sounds kind of simplistic, but how many of you out there have ways to gauge the follow-through? Or even better yet, have ways to gauge what it is that you need to see before you'll assume there's any kind of follow-through? Does that make sense to everybody? You know, maybe it's the Dow's movement. You know, right now, a lot of what's dominating price action is the fact that the Dow and the dollar are both arguably stuck in a range right now. We've actually talked about this a lot over at the Daily Forex Trading Edge. You know, where is this confusion coming from right now? A lot of it's coming from the relationship that the Forex market has to risk and how risk is represented in the Dow and the dollar. You know, we can look at risk in the Forex market if we look at, say, the Aussie yen. I think the Aussie yen and Euro yen are both very interesting ways to look at risk. I think the Euro yen is a little less helpful right now because of the Euro. Okay, but the Aussie yen is a terrific way to look at risk. One thing I need to remember about the Aussie yen, though, is the Aussie is very weak right now, the Australian dollar itself. So when I look at the Aussie yen, I can get an idea of risk, and for the most part, it has been risk off. In fact, if we think about the way we've gotten to kind of the pessimism, the bearishness that had been on Wall Street, the Aussie yen rolled over, which is to say we were in an uptrend that then transitioned and then triggered a short. The Euro yen did the same thing. It was in an uptrend, transitioned, and then triggered a short of its own. Okay, the Dow rolled over out of its uptrend, triggered a short, and then on non-farm payrolls Friday, the dollar yen just kind of grudgingly did the same thing. So it's the laggard here. It's the laggard. So if prices are going to, if we start to see prices reflecting more bullishness, more of optimism, more of risk appetite, the dollar yen is probably going to be the first one to move up higher. There's a good chance of that. Okay, but I can look at a reflection of risk through the Aussie yen. Again, a lot of the confusion we're having right now is because overall, when we look at what's occurring in this marketplace, we're dealing with a tremendous amount of confusion about whether or not the dollar is going to be able to follow through lower through the support levels that it had been testing. Is it going to be able to follow lower through near-term lows? Is it going to be able to push to lower highs and lower lows? It really has been kind of taking away a lot of the momentum the bears had, say, going into last week and even into non-farm payroll. And now it's kind of, in many ways, acting quite resilient. That resiliency makes the risk picture that much more blurry. That's what's keeping us, by the way, from pressing the lower lows on the Aussie yen. Again, more transition. How can I handle this transition? How can I handle this confusion, this range-bound chop? I will retreat to the shorter-term time frames. I'll look for clarity on the 15 or the 5 or the 30. I'll limit my trades to those short-term time frames that can handle the quick transition from bullishness to bearishness that we're likely to see within the context of a market that really doesn't have a firm opinion about what the environment really is right now. I mean, that's the bottom line. So if I'm going to look at transition as a way to warn me about volatility, the vulnerability of a fresh downtrend, I do also want to know why we're so vulnerable. And here's a little bit of the why. All right? Does anybody have any questions here? And by the way, you know, I'm actually looking at a lot of, on the other screen, I've got two screens here on my presentation computer. And I'm looking on the other screen at some of my positions that I have in the market right now that are based upon this risk-off attitude. One, by the way, I'll just share with you right now. You know, all my cards on the table. I want you guys to know what it is that I'm doing myself. Let's take a look at the Aussie US dollar. This is a pair that, for my expectations, the follow-through that I'm looking for, what I'd like to see here is continued pressure on that 200 period simple. That is a big part of what I need to see for trades that I want follow-through on to continue lower. Whether that be intraday like a 30-minute swing or a 15-minute swing or even 5-minute between the greens, whatever you have. Everything right now is really contingent on us determining what it is that this 200 period simple is ultimately going to be. Is it going to be support, or is it ultimately going to be resistance? Another one, and this one's giving me fits, I should mention, is the euro yen. I realize that I'm wandering into a fresh transition and a fresh downtrend. This market has not been chopping along for very long. Let me show you an example of a market that's been chopping along for a very long time. In fact, today's daily Forex trading edge, I talked about the daily euro US dollar. This is a market that has an established chop. There's nothing transitional in terms of a fresh view of this chop. We've been here for a while. This is a choppy sideways range. And that's fine. There's nothing new about that. We've been established here. But then contrast that to where the euro yen is right now, and you'll see this is actually just now trying to find its way into, am I going to turn into a downtrend or am I going to turn into sideways chop? That's the vulnerability. That's the difference. There was a time that the euro US dollar was looking that same way. We weren't sure until it continued to move along within that sideways range. Could the euro yen do that? It could. For now, it looks like a fresh downtrend, a fresh and vulnerable downtrend, subjected, you know, the volatility that it's going to be subjected to is probably going to be about as high as anything we're going to be looking at right now. You know, is the yen going to continue to strengthen against the euro? If the yen strengthens, that's reflection of a risk-off or risk-averse environment. So those are all important things to keep in mind in terms of what it is that we're going to continue to look for, with the Dow just not giving us any kind of clarity whatsoever. All right. Okay, you guys are awful quiet today. So either I'm answering everything very, very well, or I've confused the heck out of everybody. Maybe somewhere in between. And maybe you guys are all just ready for the weekend, which if it's that case, I can completely appreciate that as well. No doubt about that. All right, let's take a look at a couple other pairs. All right, and by the way, I still have a position based upon, and even though it's volatile, I know that I'm going to have to sit through a little bit more potential pain, but I am looking at the euro yen pressing down lower. The nice thing about the euro yen is, even if all I'm expecting is prices to go visit the 200 period simple, that still gives me plenty of room to run for a potential profit target. All right, and that's what's happening on the euro yen. Okay, let's take a look at the euro US dollar and what the options are when we do have an established chop. Okay. All right, so in terms of what we do with a market like this, again, I'm definitely going to look to short-term time frames for clarity. And right now we just don't have any. So I'm going to focus on 5, 15, 30 when we do have this kind of daily chop. And by the way, the euro US dollar is not alone. It has company in this ugly daily non-trending directional bias. The Aussie Canadian dollar, or I'm sorry, the Euro US dollar has company by way of the US dollar Canadian dollar. The dollar Canada is moving in a sideways range. Another one with chop accompanying the Euro US dollar, the dollar Canada, is the Kiwi, New Zealand dollar US dollar. Again, another market in chop. If you guys were to decide that you don't want to trade markets that are moving in a chop, I will never say that's a bad idea. I will never ever say it's a bad idea to avoid a market that's moving in a chop. You're never going to hear me say that's a bad idea, because it is tremendously difficult to gauge not only the psychology, but the potential for follow-through in this environment. So we talked about follow-through. That's a big part of this. If I don't have follow-through, why is it that I'm even getting into a market? Because the whole point is to be able to take advantage of the follow-through, right? So keep that in mind when you're setting up your trades. What is the potential for follow-through? Can we see the market have some sort of opinion that can continue in such a way that it will eventually lead us to where we want to go, which is our profit target? I mean, what other reason? That's our expectation, right? When we get into a trade, we want to see our profit target. I don't think that's any surprise to anybody. So why not just make it a part of what my expectations are? All right, so chop here. If you want to avoid the Euro US dollar, the dollar Canada, and the Kiwi, there are plenty of other pairs that are moving that aren't in this tight sideways range on the daily. There is more clarity in the psychology. And in the end, what we're looking for is clarity of psychology. That offers us our beloved follow-through, right? Okay, so can I have a look at the, okay, that I have to probably tell you that's a pair that I have not looked at all in a very long time. So that being said, that is the pound sterling New Zealand dollar. So first of all, do I have clarity on the daily time frame? Well, I am just now breaking the 200 period simple. That is an interesting development. Okay, so there's a certain amount of acceleration and bullishness that would accompany a move like that, and I could absolutely set up between the greens as this market moves up higher on the 5-minute. Okay. I could look for opportunities to take advantage of, let's see, the 15-minute time frame hitting up higher. Sure, not as established. The 30 I'd probably leave alone for now. So I'd say if I'm interested in this pair, it's going to be likely on the 1 hour or the 15-minute time frame. The 15 will afford me near-term swing buys, but this break of the wave back here makes me a little hesitant to set up another swing. So what I'll tell you then is focus on the 1 hour. And what we'll need here after we pierce the 200 is a little bit of a correction. So I would look for a near-term intraday 1 hour swing trade on the pound sterling New Zealand dollar. So thank you for that question. Did I understand well that I have to look at other related pairs if there's follow-through? You know, Jen, what you're looking at when I jump over to the Aussie yen is a reflection of risk. So you don't have to. You don't have to. But it's good to understand what's powering the move. Like, for example, we had a lot of yen movement this morning. And the pair that I noticed it on first, it was alerted to me in a chat room that I do in the morning, was on the euro yen. Someone in the chat room said, hey, the euro yen's moving. And I said, okay. I said, well, the only way I'm going to know if it's a euro-based move or a yen-based move, is it the base currency, the second currency moving the pairs, to start looking at euro-related pairs and yen-related pairs. And after a quick look, it was definitely a risk play because the Dow was moving, the dollar was moving, and my yen in the early morning, early this morning, about 4 hours ago, was moving to the Dow at that point, selling off a bit. So the yen was strengthening in that environment, and it was actually pulling down the euro yen. So you don't have to, but it gives you a clearer picture when you start to understand how no market, no symbol is an island, and there's so many they're all intertwined with one another, especially when you talk about pairs, but there's so many correlations you can look at. And even more so, it's about understanding the impact of risk on the market and what markets will be able to reflect risk to you the best. So you don't have to, but looking at the Aussie yen will give you a good idea of the risk environment. It will give you a good idea as to whether or not the dollar could strengthen or weaken. It will give you a good idea as to whether the Dow could strengthen or weaken. The Dow, of course, will have a relationship back to the yen, the carry trade, whether or not the yen will be borrowed or bought. So we can continue to kind of have that common thread through all our trading. And when you can do that, you're looking at the market in a much more connected way, kind of a holistic way, if you will. Okay? So thank you for that question. It's a terrific question. All right. What is a good pair to look at when risk is off? What's a good pair to look at when risk is on? Well, you can look at any pair depending upon that. Because if risk is off and I'm looking at the dollar yen, which way is the yen going to move? So if you want to keep a bias of being long or a bias of being short, that would be one way to look at it. But really it's a matter of which pairs will strengthen and which pairs will weaken. I think maybe that's what you're asking me there, Bobby. Thank you. That's a terrific question. I don't know that anybody's ever asked me that before. That's a great way. That's a great way to look at the market sometimes, and that's what we try to do. So let's put it to you this way. When risk is off, which is the same thing as risk off the table or risk aversion. Risk aversion typically means we're going to see a strong yen. Okay, so that would mean we'd see weakness on pairs like the Aussie yen, the euro yen, the dollar yen. Okay, we'll see weakness on our Aussie pairs. If the Aussie is the first currency, we'll see weakness on our Aussie US dollar. We'll see weakness on our another pair that I've been trading a lot lately is the Aussie Canadian dollar. Okay, if risk is on, that typically means a yen is going to be sold. Weak yen. Weak yen means moves higher on the Aussie yen, moves higher on the euro yen, moves higher on the dollar yen. If risk is on, commodities will typically appreciate as well. Stronger crude means a stronger loonie. A stronger loonie means a weaker US dollar, Canadian dollar. Okay? If we see gold moving, and I won't talk about gold and risk in the same breath because it really isn't a great risk barometer anymore, but if gold is moving, I could look back to its relationship with the Australian dollar itself. Okay? So that's a great question. How do these things connect in that risk environment? That's part of what I start off every morning doing. One, assessing the risk environment, and two, then kind of continuing that mindset of, okay, if risk is on or if it's off or it's convoluted, what are my opportunities? Where do I want to position myself in relation to COM dollar strength or COM dollar weakness, yen strength or yen weakness? If it's a blurry picture, which time frames do I want to focus on? Being more short-term definitely would help, and that's one of the environments we're in right now, that transitional, that confused environment. So thank you for that question. All right, any other questions here? Okay, how do I tell if risk is on or off? Okay, risk is on or off based upon move. Okay, number one, what does it mean? For those of you that may not know what it means, risk on means risk appetite or greed. Risk off means risk aversion or fear. How can you tell? It's movement in the Dow, movement in the dollar, movement in commodities. Risk on typically accompanies stronger commodities prices, a stronger Dow, a weaker dollar. Doesn't always, but that's usually some of the hallmarks of it. Risk off means typically weaker equities markets, stronger dollar, weaker commodities. So I look to a lot of times the futures pairs, and in the morning when I do my chat room, that's where I start my conversation. That's a great question, Rob. How do you tell? You start off with that first assessment of where is risk, near term and long term. We might have a risk on type environment short term, say 5, 15, 30, but longer term it might be risk off. So realize that short term and near term psychology versus long term psychology could sometimes be at conflict. Okay, baked into the cake is just another way of saying discounted. Discounted means if there's something like an economic report that we know is going to be released, and we already have a consensus number for it. For example, imagine non-farm payroll. There's always a number that everyone's expecting non-farm payroll to come in around. That number is then factored into price, discounted, and that's what it means. That's what it means baked into the cake. Okay? And yes, these sessions are all recorded. Thank you, Joe, for asking. These sessions are all recorded and will be available at YouTube at a later date. Okay? Yeah, I would be happy to do that. That's a great idea, Khaldun. Write about risk off and risk on and the way pairs move. Sure. You know, that's kind of a thread that goes through all my writing, but if you guys want a specific piece on that, sure. Remember, don't always assume that if it's risk on, all these pairs are going to move that way. That's but one aspect of the entire conversation. That's a broad stroke. Oftentimes, there's a lot of fine detail that will dictate the pace in which the markets move and so forth. Okay, so I would love to do that. That's absolutely fine. Okay, let's see. Got another question here. If I see a good angle on the 1 hour chart, do I enter between the green on the 5 minute or the 1 hour chart? Between the greens are only 5 minute setups. I need a trend on the 5 minute, and that's what I'll use to between the green setup. So it's only a 5 minute. So the 5 minutes got to have a trend. And if it does, then I can go ahead and lay the between the greens template over top of it. Okay, so the between the greens is its own little world. Okay, certainly if you want to respect the larger trend, that's fine, but it's a very, very short-term time frame that kind of is independent of everything else. So it's a 5 minute only strategy. How do I assess the past highs and lows as profit targets? Do I go candle by candle? I actually do, Bobby. I do. I'll look at what I call breadcrumbs. You know, where has the market been recently to show me where sentiment and momentum have shifted? I'll go candle by candle. There's a market memory for every one of the time frames, but I will look at the recent lows and highs and give them more importance because those are the freshest breadcrumbs. Okay? All right. Can you use it on the 30 minute? You know, I actually don't use between the greens on anything but a 5. I have been told by people who have adopted this strategy that they use it across multiple time frames, but I actually don't use it on anything but the 5, the between the greens. Okay, and there is the 30-minute Euro US dollar. It's moving sideways. It's a choppy market. If anything, this is a market, and this is aggressive. I want to mention that. This is an aggressive way to look at it. I have resistance right here. That's my red resistance line. I have support in this area. Okay, and this would actually be a market trend. This, again, this is always aggressive, but this is a distribution fade market trend where I will identify the ranges of the highs and lows. We have a high in here too. So I'll identify the range of the market, and then I'll go ahead and insert a stochastics. I'll put that stochastic oscillator on there. And I'll look to wait for prices to either get up into the area of resistance or down into the area of support. And then I'll look for the stochastic to either confirm that we're oversold or that we're overbought. And in that way, I can short the ceiling and or possibly buy the floor. And that's a distribution fade. That's what would be applicable on the 30-minute Euro US dollar right now. Okay. All right. Well, thank you for joining me for our twice-a-month webinars. I hope you guys enjoy them. I hope it's helpful. I hope it helps you kind of add some more questions, add some more considerations before you enter your trades. in terms of what are things to consider regarding follow-through, what are things to consider regarding a market in chomp, what are things to consider about a market that may not have a bullish or bearish dominant psychology. How do you deal with that? You know, and if you do have that market, do we even want to trade that pair at all when it's non-trending? Trending markets have a clearer psychology typically. Not that you always have to be a trend follower, but it's easier to trade a market when someone's behind the wheel. You know where they likely want to go, and that makes your expectations a little higher for the kind of decisions that the market tends to make at support resistance. You know, what kind of reaction could we get? Okay? What kind of reactions will we get at support in an uptrend? It'll typically be bought, right? What kind of reaction will we get at resistance in a downtrend? It'll typically be sold, right? So our expectation for what kind of reaction we could get is better, is clear, is more typically more accurate when there is a dominant psychology. Joe asked, why the 21 on the stochastic? Joe, that's a good question. I actually was wanting a slower setting, and it probably, at this moment, it escapes me why I settled on 21. I know that I was using a 14 for a little while. I think really when I was looking at stochastics, they seem to be used in this, you know, kind of in numbers divisible by 7. And in terms of the 21 reading, I just wanted to slow it down. So having been at a 14, it made a lot of sense to look at the 21 to slow it down. I didn't want such a sensitive, overbought and oversold reading. I've got a question here about the cable. Sure. All right, so looking at the 30-minute cable and looking at the 15, I would actually do nothing with either one of these time frames. I would actually do nothing with either one, quite frankly. Yeah. Okay. If any of you have technical issues, Anatoly, I would say call customer service. I really can't help you there. I wish I could, otherwise I'd be happy to. But if you call customer service, they'll help you get the mini terminal working. Isn't that awesome for those of you that are using it? They'll absolutely hook you up, buddy. I can complete. It's just a great thing to have, so I hope that they are able to fix it for you. Okay? But to answer your question, Clara, no, there's nothing I see as really something I would do with a 15 or 30-minute cable right now. Okay? Okay, so I will see you all for our next presentation. Be sure to check out the updates over at the Daily Forex Trading Edge, and also you'll be able to register for the next presentations right from the website. So thank you as always. Great questions. Thank you so much for your time, and I'll see you in the next webinar. Take care, everybody.